All right. So let me collect the clawbacks for starters.
And make it pretty.
It was so hard to make it. I didn't know if I was. Oh, I thought it
You know, it's
was. See that if I wrote this in your next I get to play that.
Hey, you're turning in your whole everything together. So if you don't have a, yeah, I'll take them pile. I'll restaple if I need to. So just pile them. That's right. I don't want to take the time. Just pile them. I mean, you guys can, but I don't think that. As long as, yeah.
Some of it. Some of it,
Yeah, as long as your name's on the stuff, it should be all right.
I said twice on this one. Well, I actually told them that, I like, my photos that I take, they like in here, so they were still. Yeah, so they were having
I'm not saying I don't
All right. Did I get everybody? Last call. Yeah. Everybody here today. Well, these two are going to be right. Okay, so any questions before we start? So we've got, we're going to wrap up chapter 17. I'm going to hold off on a test for 17. We'll see how that rolls out. You will be tested on it eventually, but we'll see how that shakes out here. So I'll let you know as soon as possible. I'm going to kind of quickly go through some the PowerPoints that you guys have access to that work through what we did by hand last time. Just to kind of review what we were trying to accomplish. So this chapter is called the money supply process. Yes.
Where are these
If you go on to your MyEcon Lab. In fact, I'll end up showing you because I'm going to go to some real-time data today. So, but yeah, on the MyEcon Lab, chapter has resources for the chapter. So if you go down to chapter resources and click, and boom, you can get all the PowerPoints there. In addition to these, some other things that are there, other supplements as well. Okay. All right. Uh-oh, that didn't sound good. Ooh, that was a laptop falling. Yikes. Hopefully those Mac laptops are, MacBooks are bomb-proof. They're not, from experience. Okay, so here's that simple multiplier again that we've gone over a couple times. This is what we did in Principles of Macro class. 1 over the required reserve ratio, change in reserves. It was really kind of change in excess reserves that was created. The things we talked about last time, holding cash. If banks don't loan out all the cash that they can, the excess reserves, right? So that's what's going to cause currency drains and cause the multiplier to be less than the maximum it could be. All right, so the money supply is tied into the monetary base, and that's why we spent a little bit of time on that. So the monetary base is what the Federal Reserve tends to watch most closely and calculates the money multiplier, which was the more complicated version that we did. Okay, so the little variables that we created last time, little r, little c, little e, right? The amount of excess reserves being held by banks, the amount of currency being held by the public, and the required reserve ratio ends up being giving us these changes. And so what you need to know for this chapter is the direction of those changes with the money supply. So if the Fed changes the required reserve ratio, if they change it up, what happens to the money supply? It goes down, right? So that's what these arrows are doing. And they don't do it as much in this chapter, but I think for myself, it's easier to tie it back with some graphing goggles and think about the money supply and money demand, dollars, and the interest rates. So as the down arrow, along with any of these maneuvers here, changes in currency holdings, if the public's holding more currency, that means there's going to be a decrease in the money supply, right? A currency drain, less of a multiplier. And so all of those movements are causing a contraction of the money supply. And now we can start to tell the story of if the money supply is going down, interest rates are going up, right? So that's what we're trying to track in a little bit more sophisticated way in this chapter of really looking at the money supply. Okay, questions or comments so far? Just going to kind of breeze through. This is mostly just review of what we did last time. The money multiplier, little m. So we're looking at a connection between money supply, which is this line, quantity of money, and the monetary base, which was the liabilities of the Fed. There's our currency reserve. This is the math that we worked through last time. I'm kind of just wanting to kind of give you a quick overview to let you know that these resources are here and kind of walks you through what we did last time. And that was deriving this formula, 1 plus the currency ratio over the required reserve ratio plus the excess reserve ratio plus the currency. Okay. And then here's the example we did, where the money multiplier is much less than the deposit multiplier, which would have turned out to be 10 in that case. All right, so now the last little bit of this chapter gets into the impact of this over time. And so we take a little bit closer look at what happened during the financial crisis. So, and what quantitative easing is. So we've got the financial crisis set into play. We watched the video about what that crisis was and what maybe started it and why the system started to implode. And now what we're looking at is the policy response to the implosion, right? So the economy starts to go in the crapper in 2008 because of the subprime mortgage crisis, blah, blah, blah. Wall Street's going bankrupt. Individuals are going bankrupt, right? The whole system, kind of that last part of the video where everything's just kind of falling to pieces. Now, what does the Federal Reserve do in response to that is part of what we're looking at. And so the general idea was to provide liquidity to the system. In other words, let's not pull back on money. What the idea would be is to stimulate the economy, to allow money to be a little bit easier so that maybe in theory there could be some rebuilding. All right, so they did that by entering into bond markets, and traditionally the Fed stuck with really short-term bonds, so mostly T-bills of 1 year duration, maybe 3 to 5 year duration. But what we started to see the Fed do was go into longer-term instruments. Was kind of a new thing that they started to do. And this led to some startling increases in the monetary base. And we're going to look at some graphs later that'll kind of show you that that was unprecedented on what they changed in the policy response that they did. All right, questions or comments so far on the financial crisis to kind of tee this up for you? Anything from remember that video we watched? I don't think everybody was here, but hopefully you watched it on the recording if you weren't. Yes?
I want to say a question.
Oh, that's okay. That's what I want to do is kind of tee you up. So tell me.
Not official cause, but what was the main cause of the collapse?
It was kind of multi-pronged, but the things that they pointed to in the video was the Fed interest rates really low, maybe arguably for too long of a period of time, kept money too cheap, which caused people to, in the Hayek sense, there was malinvestment. So, for instance, a family that normally couldn't afford a $300,000 McMansion said that, wow, with interest rates only at 4%, I can afford that. And with regulations down, I can afford that, right? And so people started putting their hard-earned savings into, gotta buy a house, gotta buy a house, gotta buy a house. Why did they do it? Because the Federal Reserve kind of distorted the pricing system. So when the government comes in a large way and distorts the pricing mechanism for not only housing, but all kinds of goods, but especially interest rates, because they have a role in purchases, especially when we have a credit-driven culture, that we tend to just get a car loan, get a house loan, get my clothes on loan, get my MacBook on a loan, loan. When we have a credit-driven culture, then we tend to be more sensitive to interest rates. And when interest rates are low, we buy. And so we have more of the purchases going into those types of investments. If interest rates had been higher, those people would have made different choices. Now, and the same thing goes for businesses. So if businesses have kind of an idea that, this is probably a good idea, maybe we should invest in it, maybe we should have, I'm calculating that the internal return is 9%. It's a little bit risky, but interest rates are only 5%. So I can borrow money at 5, and I have an expected investment that's going to earn 9%. Let's do it, right? And so the company goes and does that investment, whatever it was. Maybe it was buying a new machine, expanding their business, going into a new territory, Lord knows what, right? So some sort of business expansion. Because interest rates were low, they did it. Now, if interest rates would have been market-driven, then let's just say the market rates were at 8%. Expected return of that investment is 9%. It's like, that's not enough margin for me, right? I'm not going to do that investment. And so we end up having capital going into things that maybe shouldn't have been done, is one way to look at it. And those things tend to be sticky. And so when some of those things start to fail, or other things, external things happen to the economy and people can't pay their bills, then all of a sudden asset prices start to pop. And so having housing prices fall because people were into houses or too big of houses than what they really should have been into, that's what caused kind of the crumbling of things on multiple levels. All right, that was kind of a long-winded answer. Does that help?
Yes.
All right, any other comments or questions that spur? Yeah.
Interest rates don't affect the money multiplier?
Correct.
Okay.
Yes. Interest rates, right. So interest rates are part of what the, if you wanted to think about it being the dependent variable, is going to result, because depending on what that, those three variables, the required reserve ratio, the excess reserve ratio, and the currency drain, the currency ratio, that's going to affect this, which ultimately affects interest rates, right? So it's not, it's interest rates that are being changed by that stuff. Yes?
I think we.
It's okay.
So when you increase that like add to people's.
So when you increase the money supply, why does that add to people's want to spend?
Yeah.
Okay. And when you say, okay, so interest rates are the opportunity cost of money, right? So the cost of holding money. So if I money demand in kind of the Keynesian liquidity preference framework talked about the trade-off of bonds versus currency. So if I'm holding currency, if that green stuff there, I'm not earning interest, right? But as interest rates start to fall due to a monetary expansion, it's effectively cheaper for me to hold money in the form of currency, right? So the quantity demanded of money increases. And if interest rates are low, then borrowing might be high. So they might be purchasing more things, the things that they would buy on credit, okay? Anything else? All right, those are some good foundational things to keep in mind as we look at this. All right, so the monetary base continues to swell. And I've got a little video that I didn't have queued up, but I think I'd like to do it. Now, let me go one more slide. Okay, well, I'll play this after there. So, and actually, I'm going to go to the real-time data here too. So, monetary base before the crisis, M1, not M2, but M1, looks like this. And so, the monetary base grew higher than what the money supply was, which is really weird in the course of history. So that's one little blip that went on. So let me get, let's see, here. Sorry, I was kind of thinking I might do this, but I wasn't sure, so it shouldn't take me too long. Let's go to the Russ McCullough inventory of videos. Let's see, quantitative easing. Here we go. Now, this is actually done in British pounds. So she's got a really pleasant voice, but it works the same way for the United States. I'll start with here. All right, here we go.
Quantitative easing, how it works. The Bank of England's Monetary Policy Committee has been purchasing assets financed by new money that the bank creates electronically. Often known as quantitative easing, this policy is designed to inject money directly into the economy. This is in response to a sharp demand as businesses and consumers reduce their spending. In short, there's not enough money in the economy. The aim is to boost spending to keep inflation on track to meet the 2% target. Alongside its decisions on asset purchases, the Monetary Policy Committee continues to set bank rates each month. The bank purchases assets from private sector businesses, including insurance companies, pension funds, high street banks, and non-financial firms. Most of the assets purchased are government bonds. There's a large market available, so the bank can buy substantial quantities of assets fairly quickly. The Bank of England's injection of money into the economy works through different channels and has a variety of potential effects. When the bank buys assets, this increases their price and so reduces their yield. That means the return on those assets falls. This encourages the sellers of assets to use the money they receive from the bank to switch into other financial assets like company shares and bonds. As purchases of these other assets start to increase, their prices rise, which pushes down on yields generally. Lower yields reduce the cost of borrowing for businesses and households. This, in turn, leads to higher consumer spending and more investment. Of course, higher asset prices also make some people better off, which provides an extra boost to spending on goods and services. The Bank of England is also buying small amounts of private debt, like corporate bonds. These purchases are aimed at improving conditions in capital markets, making it easier for companies to raise money, which they can invest in their business. There's another way the bank's purchases of assets could put more money into the economy. Those selling assets at the Bank of England deposit more money into their bank accounts. So commercial banks have more funds which they can use to finance new loans. And more bank lending supports spending and investment. But this channel is likely to be relatively weak as banks continue to repair their finances in the wake of the crisis. That's why the Bank of England is buying most of the assets from firms other than banks. The extra money the Bank of England is injecting into the economy should increase spending to help keep inflation on track to meet the government's 2% target. Without that boost, the amount of money in the economy would be too low. Spending would be weaker and inflation might fall below target. But as perceptions of an improvement in the economy begin to spread, this will stimulate business and consumer confidence. That will help to underpin expectations the policy is beginning to work, which should itself encourage more spending and inflation in line with the target. As it sets policy each month, the Monetary Policy Committee will continue to be guided by the outlook for inflation relative to the 2% target. If the committee thinks inflation is set to rise above target, it could raise bank rates and sell assets to remove the extra money it put into the economy.
Okay. Questions on that little video? This one. This one. Alright, the Treasury Department, Janet Yellen currently, right? Remember Nancy before? Okay, questions on that one? Okay, let's hear them. Comments, questions? Yo. Yeah, well, they do know a little bit, yes, and that'll be part of the data that we'll take a look at. But in short, if they printed off money like this video just said, which is what they've done, by the way. I mean, that video is not too far off. It's kind of common lit. Government goes into debt, deficit, really, right? Not enough current tax dollars to pay for spending. So they sell bonds, but then Janet buys up some of those bonds. So that's what they were illustrating here. So once the Fed injects that money into the system, if people are holding it because of currency, so if households aren't spending that money, they're kind of hoarding cash, if you want to think about it that way. And if the banks aren't loaning out the money, they're holding excess reserves, then that destroys the multiplier. And so that's what's been going on, is that the money's not getting out into the system the way it normally does. And the way it normally does is that banks have excess reserves, they loan them out, right? And that was that whole simple multiplier process. They loan out the money to Eric. Eric goes and runs to Walmart and buys some rinky-dink stuff. Walmart pays their employees. The employees go out and deposit their check, and then that bank loans out their excess reserves. So that whole deposit creation thing erodes away if there's an increase in E, little e that we saw with the multiplier. They're going to hold more excess reserves, or an increase in little c, people holding more currency. So that's the answer in short, is that we're not seeing the inflation, we're not seeing the impact because even with interest rates low, there's not a taste by businesses and consumers and banks for taking on that risk, because they're kind of thinking we're just around the corner from another financial crisis. And what we learned in the financial crisis, especially me being in the real estate business, is that cash was king. In other words, as a real estate owner, if you have a real estate portfolio, you didn't want to be leveraged to the hill. If you had $10 million worth of real estate, might not be a good time to have $8 million of loans, right? So $2 million worth of equity. If you've got $10 million worth of real estate and 80 or 800, 900 million dollars of loans, if the crisis happens and asset prices tumble, if they tumble by 10%, if they tumble by 20%, which we saw in some cases, your $10 million real estate portfolio is now worth $8 million. And you've got $8 million of loans. You own nothing, right? Your balance sheet, you just wiped out your balance sheet. So you've become illiquid. You couldn't sell off your assets to pay for your liabilities. Not a good position to be in. So people are hunkering down, leaving themselves in bigger asset positions to ride that out. And that comes in the form of currency as well as other things. Okay, other questions or comments there? Yeah.
So inflation's is at 2%. Like every year, it's supposed to, like the previous year it was at a certain point. So every year it has to be like they're trying to meet it at 2%. So our price is supposed to keep going up and up and up every year.
So yeah, they monitor the prices by the consumer price index, and they collect pricing information. And so if money is printed out, like running the printing press, then there'll be more money out in the system, which tends to bid up the prices of goods. And so that causes upward pressure in prices. And so they monitor that price change. But what we haven't seen with this one is that despite dramatic increases in the money supply, we haven't seen the inflation fall. And that's because of this currency drain and excess reserves.
So like a bag of chips, like 3 years ago, like is that why like bag of chips costs more like right now?
Yeah.
Just keep going up.
Yeah,
like,
that's right. Yeah, it's just market forces that are putting it out. But part of the forces isn't really market driven if the Fed is increasing the money supply. That's not a market driven force. That's the government kind of printing out money or controlling the flow of money. And so that'll get into the kind of the quantity theory of money that we'll talk about more later. But yes, and so in Venezuela, you guys saw that article, right? As part of our stuff. What was it with? I think that was part of that article set, or did I read another article? With how much did rice go up when they released the price caps?
18 cents. $2.
Yeah, 18 cents a pound to $2 a pound, right? So the government, in that case, I mean, that one's a jumbled mess of who in many ways. So you have the government printing off money, which would normally put upward pressure on prices, but then you've got the government having price controls in at 18 cents that by law you can't sell rice for more than 18 cents. So market forces would have been pushing prices up, but they weren't allowed to by the government. And then you saw the pictures in the article, right? Lines, people starving, literally starving, because there's a shortage of goods. No seller wants to sell rice at 18 cents a pound when they can't get it for that amount, right? And so we have a classic prediction from Econ 101 that a price ceiling causes a shortage. And in this case, people will be starving. So then they release those price caps. And now your person who's earning minimum wage has to face a $300 food bill on a $500 a month budget or something. It was just so far out of whack. It's kind of crazy. All right. Anything else? Yeah.
Okay, so if people like aren't spending,
If people aren't spending, can we assume they're saving? Yes, in some respects, you're either doing one or the other. So if you have income, you're either spending it today or spending it tomorrow, so to speak. So you're saving the money. But the value of the savings can be eroded away by inflation. So that gets us back to the Fisher formula, where what is my real rate of return for my savings is the interest rate that I earn on my savings minus the inflation rate. And it's possible that this could be negative. And so if the government is doing irresponsible things so that I was earning 3% on my savings, but the inflation rate is 50%, like it is in Venezuela, in a month, they're predicting that it's going to go up to, what did that article say, 500%? That's annualized, 500%. So if it goes up to hyperinflation levels of 50% a month, then we got a pretty big incentive to not save. And so people will be spending their money is ultimately what that means.
Yeah, very like in the United States.
Okay, so where it's more normal, you mean?
Yeah.
Okay. So if they're not spending, they're saving. Yes. Is that what you're asking?
Yes.
Okay. So if you're not spending, you're saving. You're doing one or the other. And then part of that, maybe, I don't know if this is part of your question, but how you're saving your money is also different. So are you putting it into a money market mutual fund, or are you investing it in Apple stock, or are you putting it into some other longer term investment? So that is different too, because if they're putting it into, what people aren't doing now is putting it into longer term investments. And that's creating a bit of a drag. All right, anything else? We'll keep talking a little bit more. I got some more, I want to switch over to this thing. This gizmo. Okay, so this gets back to Mitch's question. I just logged into MyEcon Lab, so you guys have access to all this too. So if you go to the chapter resources, pick chapter 17, and then you can pick the PowerPoints and all of that stuff, and it'll find all the stuff that's available. Scroll down. So these are all the supplementary material for all of chapter 17. And there's those videos that are part of the interactive thing with the e-text too. And what I wanted to look at was the real-time data, which is kind of cool. Let's see. So this directly links us into FRED, which is the Federal Reserve database that we did before. And so this is all live interactive stuff. And this gives us today's data and otherwise. So this is more current than your textbook is, because the textbook was published a year or two ago. In fact, I think this is what it's giving us. The textbook is out to this time frame, 2014. And then, yeah. So what the textbook gives you is what the textbook, like if you look at your static figures in your book, then it's this picture. But what this allows us to do is now drag to today. And so this is the real-time data as of September 16th. So September 2016, this is the latest thing of what's happening. So we've got the monetary base, financial crisis spiking above, and then this is the quantity of money for M1. And that's the impact. And then what I think is extra fun for an economist anyway, is being able to look at what was it historically. And now you start to see that this is something unique, right? 1960, the red line always seems to be above the blue line, right? So that is something that's different. And so not having people loan out funds, loan out their excess reserves, has led to the Fed scratching their head today. Questions or comments there? So this is the relatively current picture within the last few years. So this is millions of dollars in billions. So this is 1.1600 billion, which is how many trillion? 1.6 trillion, right? So 1600 billion. So this is what's happened with our money supply. It has been going up during the Obama time frame, but we haven't seen the inflation. Money supply, if we were to do a percentage change here in M1, what do we got? 3,200 minus, if we go back to here, the 1,600. Who's got a calculator handy? 3,200 minus 1,600 divided by 1,600. Kaylee's got one. It's a big number. 3,200. I'm just kind of going to today's number roughly. 3,200 minus 1,600 divided by 1,600. That's 1. So what does that mean? What does a 1 mean? 1% change? 100% change, right? So 100% change in money. And that means quantity theory of money that, again, we haven't gone into detail with, but we did in macro class before. Milton Friedman says, if money supply grows by 100%, how much is inflation predicted to be in the long term? 100%, right? So this is what people are quaking in their boots about. Back when those of you who had me for macro, and even when I was back here still teaching at Iowa State University, I was making the prediction that we were going to have inflation in a big way here coming up. And so this is one of my many failed predictions that hasn't worked out so well. And most economists agree this has been a head scratcher, that we haven't seen inflation. So it shows you the power of people making their own decisions, that they can offset government policy by their behavior many times and their expectations about the future. Because the old rule of thumb was if they increase the money supply, then 3%, then there'd be inflation of 3%. But that assumes that people are operating normally, that they're not holding on to cash, that banks are loaning out excess reserves, and so they're basically able to undo the policy. Joe?
Since the monetary base is so much higher, there'd be like a delay in the inflation where we're going to experience like really high inflation.
That's what I keep thinking is going to happen, yeah. And so here's the other thing that's kind of interesting. The quantitative easing, the bonds that they were purchasing, I told you that it's usually 1 year, 2 year, 3 year bonds. Well, for the first time in history, they started buying 20-year bonds. So they went into long-term capital markets. And so now, with that money out into the system, it's a lot harder for them to reel it back in. So if inflation does take off, I'm not so sure how many tools they have at their disposal to bring it in, or the political will to pull it in. Are they going? And when Wayne Angell was on the Federal Reserve Board, Paul Volcker and him were known as the inflation hawks. That they made some courageous policy moves by driving the economy into recession harder than what some people would have thought was a good idea. And they did it because of this inflation issue. We came out of the 1970s where inflation rates were really high, and so they sucked in the money, drove up interest rates, drove the economy deeper into recession. But then after that, we had a long expansionary period during the Reagan era. So there's that's what we kind of keep waiting to happen, and all the data points that that's going to be at some point. But it might be slow, and maybe it'll be manageable, but it's not necessarily going to be that easier said than done.
When you say inflation is going to increase most likely in the next X many years, are we saying like it's going to jump by 10%, or are we saying like 1% here and there and then take off?
It's anybody's guess at this point. So in theory, the Federal Reserve, thinks that they have policy options at their disposal, but any option that they do is going to cause potential recession also. So the worst thing that could happen, which happened in the 70s, is that we have increasing inflation and decreasing real GDP. So we have the economy in real terms losing jobs, et cetera, and prices going up at the same time. That's not a good, situation. So I hope that those
So excited.
managers have that all under control.
So psyched.
Yes, Eric.
So you as an economist, like when you were making predictions, did that affect a lot of your decisions that you made, like investing or things like that?
Yeah, it brought me to Ottawa University. For real, it did. I mean, that was basically, I knew that we weren't going to get back to doing business with loans that quickly. And I always intended to go back to university life, but I thought I would have more gray hair on my head and stuff. But the market spoke, and so it caused me to make a different decision, for instance. And so there's other people too, that those sorts of swings could cause real changes in behavior.
What other plans did you have, or did you say you teach that?
I was always teaching, yes.
Oh.
Yeah, I was always still teaching, but I was teaching a couple sections of Principles of Micro and Macro for the whole 18 years I was doing real estate.
Oh,
I wasn't a full-time professor. I was kind of wearing multiple full-time hats. Okay. All right, so here's another one that's got the real-time data. This one has currency in circulation. I know this is kind of hard to read. Let me blow that up. How big? I think the graph ends up staying about the same size. But so currency in circulation is the blue line. So currency in circulation, not in bank vaults, right? And then this is the amount of excess reserves. And so again, we have them crisscrossing here, where there's less currency out there in terms of our little C, and then more excess reserves. And so this was as of 2014. What is our prediction here before I reveal it to you? So this is 2000, the data here ends at November 2014, and now it's November 2016, right? So 2 more years worth of data. What do you think? Did that sucker come skyrocketing down here? Did it turn up? Did it get worse? All right. Da, 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 da. It's narrow. So the gap here is narrowing. It looks like currency is kind of flattened out. So there is a drop in excess reserves. So there is a little more money starting to get out into the system in the form of loans. And then again, if you look at the history of this, oops, going back to 1960, I've gone to the wrong thing. Notice the difference? Everybody see the red line up here? What does that mean? They're basically loaning out everything. Yeah. So that's the way the system. That's the way the system normally worked. Is that if banks had excess reserves, that's not making them money. Let's find good places to put loans out into the system. And as the money continued to get more and more competitive and cheaper due to, in some degree, the Federal Reserve keeping interest rates low, they started making riskier and riskier loans. Right? It's like, oh, we ran out of loans for good people. Oh, I got an idea. Let's take bad people. Right? Remember when the video changed to the heavier set guy smoking with 5 kids, and it said that was kind of their pictorial of the subprime mortgage market. And so that's the malinvestment that went on because incentives were such that that was the best way to go make money.
I just wanted to learn.
A learning mom. Okay, so anything else there? Okay, one last thing here before we cut loose. My old version. This is the thing where you kind of wonder, do we ever learn our lessons? Here is the Great Depression. This is not in your notes, by the way, because this is, yes?
Sorry, back to that graph. So
Yeah.
the more excess reserves of money held in banks than money in circulation? Is that-
No, because that was M1.
Okay.
That was only M1. Yeah, they didn't have M2 on there. So you could go back to Fred and look at M2, and M2 would be bigger. So they were just trying to show the trend of currency holdings, since M1 only has currency plus checking account deposits. Okay, so Milton Friedman studied the Great Depression and looked at this back in his study in the 1960s. So this is from one of his papers that he did in '63. This was his wife, Anna Schwartz, was his co-author on this stuff too. And so 1929, 1933, and this blue line shows the deposits and how erratic it was over time. And so they were trying to, again, fix this system. By the time they started getting their stuff together here, we've got the currency ratio is the blue line being measured here. So this is the amount of currency holdings, right? And then people started holding currency. And this is the excess reserve is scaled on the right-hand side. Excess reserves, loan it out, loan it out, loan it out, suck it in, right? So the same kind of thing happened in the Great Depression time frame. But yet we don't seem to learn. Right? Well, I take that back a little bit. I'll give some credit to, I don't know if I want to give credit to him or not, because there's some disagreements, but Ben Bernanke was a student of the Great Depression. And so what the Federal Reserve didn't do here is that they didn't provide liquidity. And so that was one of the major knocks on why the Great Depression lasted as long as it did. There's some other things. There's really a lot of interesting things. But from a monetary policy standpoint, they didn't react with liquidity. And so that's part of why Ben Bernanke reacted the way he did. So could it have been worse? Could it have been better? That is always hard to tell. But I think people, in general, look at what Ben did as a good thing. There's people that disagree. I'm kind of on the fence on that too, whether we needed to do at least some of the activities that we did. We'll talk about that when we get to investment finance class as well. All right, we'll call it the day there. That wraps up chapter 17. So your homework, by the way, is still due, so it's just the test. So make sure you check out online that.